Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me today an old friend, a guy I've known for, a couple of decades now, I suppose, Peter Grandich. Peter really doesn't need any introduction, I think, to most listeners on this show, if by any chance some of you listening out there aren't familiar with Peter Grandich, who's a very prolific writer and blogger, and has been around these markets for not quite as, just about as long as I have, I guess. But you should go to the Voice America Business channel, the website, go to the Turning Hard Times into Good Times page at the Voice America Business channel website, and there you can read Peter's bio as well as the bios of all the other guests that appear on this show. But suffice it to say that Peter is a very savvy market analyst, but one who thinks his creator is the originator of his talents and his gifts, so he gives thanks to God for that. And I'm quite sure one of the things that I've really appreciated about Peter over the years is that realizing that what he has is not only his own doing, but sourced from his creator, is that he then shares with other people. And he has run a number of events over the years, as well as giving of his own money, but it has run a number of events over the years in which he's raised money for people that were unfortunate for one reason or another. So Peter is a special guy in my view, and he is also, as I say though, a very savvy market analyst. So welcome, Peter. Really glad to have you with me again.
Oh, I appreciate that, Jay, and I do give all the success and credit to my creator. I don't know why at times someone as a sinner as myself gets these gifts, but we can't, the old saying, we can't look a gift horse in the mouth. We just got to be blessed that we have them, and we got to make sure that we do the most with them. So I'm honored to be here.
Yeah, it's really true. I mean, we don't know, why we are blessed as we are. A lot of times we don't deserve it. But I guess those of us who are believing Christians believe that it is the grace of God, and that God loves us and He cares for us and He gives us what we need. So at least if we trust in Him, that's true. And it's very easy not to, Peter, because most everything we hear, I think we are being programmed by our government, by the educational system that we have, and I think against all scientific evidence to not believe in a creator. But that's another story for another day, and there are theologians that we've had on this show on a couple of events, a couple of occasions, scientists that have talked about this. I really clearly believe that something else at work here that wants to keep people. I do believe this, Peter, and I think you would probably agree, that if we don't believe in a creator, capital C, as our founding fathers clearly did, because they stated that in the Declaration of Independence, then we have to trust in a human being for our good graces, and that hasn't worked out too well over history, has it?
No, and you're right, and I think a major cause of the difficulties that we'll probably just touch on today that have grown in America, it's not coincidental that they've grown as America has moved away from what its forefathers saw and trusting in God and making God the true leader of the country. And so I think a whole host of those problems, and obviously now it's at the top because we have a president that has not acted at all in that manner, and because of that we have so many more difficulties. So, yeah, I concur with you, and again, I'll just say that I feel blessed, that I have this opportunity every once in a while, like a blind squirrel, and be able to be right about something.
Yeah, well, the same goes for me as well. Peter, I recall getting into the markets now. Let's talk a little bit about 2009. You turned very bullish, and that was, at a time, well, it was right at the bottom of the market, or maybe a month or two out of the bottom, but there was no way of knowing that we were on to any kind of a real sustained bull market. I don't want to say economic recovery, because I don't believe we've really had much of one, if we've had one at all. But the stock market has been on a tear since 2009, and and some people have said it's the most difficult market and the most difficult economic decline that we've had since the 1930s. So pessimism, mine included, was so thick that you could cut it with a knife. What did you see then, Peter? And maybe you were the blind sparrow that was just directed by the grace of God. I don't know if that's what you're going to tell me. But I have to think that you probably had some insights in 2009 that helped you say, no, Taylor, I don't think you're right about this now. I think we're going to see a sustained market, or we're going to see an upturn in the equity market. Could you tell us what you saw back in 2009?
Sure. There was no feeling that anyone was wrong and I was right or what have you. What had transpired was, in late 2007, I believe, like you and some others, the handwriting was on the wall that America was out of control, and a debt problem and a credit problem and a whole series of things, and turned bearish. And then in early 2009, when it was obvious that the Fed was going to go into a mode of money creation unlike the country had never seen, and a belief that when that happens, most of that money goes to the top of the pyramid, and they benefit the most. But where they benefit the most is in the markets and in financial markets. So it was really that led me to believe that despite not thinking the economy was going to do great, that the stock market, what I called at the time, would have the greatest bear market rally it ever had, and it did, and then some. And while I was no chest-beating bull and telling everybody to buy every single share they can get and enjoy a lifetime of a bull market, I didn't be like others and stay very bearish, even though they were correct in the decline in 2007. But at the same time, at the beginning of this year, I decided to put the bear hat back on, and the market has moved somewhat higher from the time that we've done that. So, I'm just like everybody else, put my legs on one leg at a time. But I did feel that we were going to get one last pop through April, May, and June. It's something I've written extensively because one of the few financial columnists that I have a lot of time for. His name is John Cradell. He's been writing for the New York Post for decades. He has been writing a series of stories of basically demonstrating and proving that the monthly employment numbers are rigged, and that there was a series of fudgings and Census Bureau takers who have fraudulently created counts, but had also noted that in the months of April, May, and June, that there would be these substantial seasonal adjustments being done that would artificially enhance the bull market. So there's been a belief in me that we would run up to the July 4th period, that the market could still make one run. But as I noted yesterday in my writings to my readers, I hate to say it, but I think the party is up, and even with the Fed still in somewhat accommodating mode, that the total weight of all the known bearish fundamentals, which I'm sure you've discussed in your show, and people don't need to hear them all from me again, but the just dramatic number of bearish fundamentals as well as technicals are going to finally bring the weight down on this equity market, and it's a time not to be very long, in my opinion, in general equities.
Well, indeed, and let me just, before we go any further, let me tell my listeners that the place to go to, I believe, and correct me if I'm wrong, Peter, but where I've picked up information that you and your thoughts that you provide for listeners or for readers is moneytalks.net. Is that the place to go?
Yes, at moneytalks.net, one word, moneytalks.net. There's a column called Peter's Content, and I write for that group a daily or almost daily market commentary in general financial markets and personal financing column.
Right, and I would suggest that it's a place that I should go to every day. I don't. I must confess, because I've got so many things to go to. But whenever I go there, I'm always pleased to get your thoughts, Peter, just because I know that you are a man of integrity. But also, even if you're a man of integrity and you didn't get things right sometimes, I would probably not think that's worthwhile going there. But you seem to hit the nail on the head a lot. And this is just one more example. So now you called the turn back then very well, and you called the turn many times in the past. In fact, you like to talk about how you became a legend in your own mind, I think is the way you humbly put it now. But you had some great calls, and you gained some notoriety on Wall Street for your calls, and it served you well in many ways. But okay, so you see the possibility now that this thing is mainly over, or could be over. I guess you think it's highly likely that's the case, and you're not alone there. There are a few others, although I think the market sentiment for the most part is still very bullish, isn't it?
It's interesting you say that there's a lot of unusual patterns this time around. You and I, you talked in the outset of us going back to entering the business in the early 80s, and I feel somewhat of a dinosaur now because the markets aren't anything resembling what they once were then. There's really nothing in common then. But there are some unusual factors in this time around. Despite the market making new highs over the last several months, the general public has not been the participant like they've used to be in the past. In fact, they've been net sellers of mutual funds. Much of this has been driven up by these algorithms and these major institutions pushing the money up. And normally the way they get out through most bull markets, how they peak, there's an hysteria phase where the public plunges in and they buy up much of this stuff and the big guys get out. That isn't happening now, and that's been the unusual thing. And my cynic view has been that's why the Fed keeps pushing things, because they need to get these guys out. And so there's this artificial belief that the economy's doing well. A classic example before we run out of time, and somebody I know we both know, John Williams, made very strong height of this over the weekend. The employment numbers were such a joke Friday. The joke of it was that, yes, there was 288,000, and yes, there was seasonally adjusted stuff and all. But we only got that number because so many people went to part-time work versus full-time work. But they don't count them as different. They just count it as employment. And to see that there was actually a net decline of 590,000 full-time workers would scare the bedevil out of most people who report it that way. And so there's just a series of things that are out there, Jay. I think that's it. The control of the currency made a report on Friday that almost no one covered, and that was a warning that we're ready for another credit crisis last seen in the mortgage industry back in 2007. Only this time it's going to be around auto loans. That so many auto loans have been packaged into mortgage like packaging where people buy the hope for rates of return. Right. And now so many of them are going to be underwater. The average auto loan is 5.5 years. That means most people who have an auto loan, their car is worth less than they're actually owe. It's just another accident waiting to happen. And it's just there's just too many glaring negatives and warning signals that are being sent out that I think it just pays heed to take an attitude of to be a live chicken versus a dead duck and just shy away from general equities at this point.
Yeah, I think that's probably a good idea, and of course, shy away from debt instruments as well. I mean,
one last thing before I run out of time too is where people have gone, and I do so much work now in our financial planning business with people 55 and over or in most need of income, because of what the Fed has done and created really a no interest rate environment. People have gone to all sorts of crazy thoughts and ideas on how to chase yield for income. Yeah. And one of the things they've done is they've driven junk bonds, or like call them high yield bonds, but they're really junk bonds, to such extremes that the spread between junk bond yields and treasuries has shrunk to levels last seen. Guess when? 2007, just before the last credit crisis. So I'll tell you this. I don't suggest to anybody to run out and short the market, but if there's one thing you said to me, Pete, what's one bearish thing if I had you back 12 or 24 months from now, if God lets us live that long, you can feel that you can hang your hat on, and that is going to be junk bonds are going to get killed going forward. It'd be the last investment I would want to own, and quite frankly, if there were ways to short it, and I can be speculative if one can be, it'd be a play right now. I think that's just an accident waiting to happen.
Well, another person who certainly agrees with you on that is Robert Prechter, in reading his latest letters as well. But, Peter, I just have to ask you, looking at, I'm wondering to what extent demographics might also play in the fact that people are not, as many people are not, buying stocks at this late part of the cycle, because usually that's how the insiders, the big money, the so-called smart money, gets rid of their paper, right? And the retail guys come in at the very end and always get hosed. The other thing I would say is we're hearing now from that governments are spending trillions of dollars to buy equities as well. So do you see this thing that possibly this equity market could be a total fraud, essentially, almost like the U.S. Treasury market is? It's totally, where the Fed steps in and buys this paper?
Well, but I think there's an argument that in a quasi way it has been doing that by creating the system that it has that has allowed these big investment houses and bankers to do all the things that they've been doing. There's no question that it's been a very narrow group that has benefited since the last credit crisis by what the Fed has done. Let's not forget the original premise on this. The thing we were sold coming out of that terrible credit crisis was on QE1 was, listen, if we can raise financial asset prices, people will feel wealthier and spend wealthier, meaning that since the stocks and bonds prices went up, people will go out and buy refrigerators and cars and what have you. And yes, in the very high wealth area, that's exactly what people have done. But the vast majority of Americans have not seen that wealth increase. We've seen it by all the statistics, how personal income is flat, wage increases are flat, yet costs are going up. And so the whole premise of the original reason QE1 was created has never worked. And realistically, QE2, 3, and 4 have been done because of the failure of QE1. And eventually, I will tell you this, when the market turns down and because the United States has allowed the Congress to get away from its responsibility of being in charge of fiscal matters in the U.S. and has put this burden on the Fed, and the Fed has accepted it and made the Fed somehow in charge of the economy as well, when the economy slips and falls and comes down hard, again, you'll see the Fed creating some type of paper program believing that they're the ones that are responsible for the solution to make things better again. And so anybody that thinks even though interest rates will go up again and all, and that the Fed will remain tight, has another thing coming because it's painted itself into a corner and has really self-appointed itself as the guardian of the U.S. economy and has allowed Congress to get away for almost 2 decades, and that includes Republicans as well. And because we don't have any fiscal responsibility more out of Washington, it's just another sin we're going to pay for.
Well, it's the animal spirits idea that comes from Lord Keynes, the notion that all we have to do is give people money and or jack up the stock market, and people feel good, so they'll go out and spend money. And as you say, the rich have, but it certainly hasn't trickled down. And it's, of course, as David Stockman talks about, they're not allowing price discovery in the capital markets by rigging the interest rates. And so we're in a mess, Peter. We have gotten ourselves, our policymakers, if they just could adhere to allowing the markets to work, but they can't, and I think one of the reasons that we can't, we touched on a little earlier, is that they no longer believe in a creator or natural law or that the universe is made and is designed. It's human beings that mess things up. And unless you can acknowledge that and realize that it's we humans that really mess things up, then I think you're always looking for animal spirits or some brilliant PhD from Princeton. As James Grant says, people have now turned to the PhD standard instead of the gold standard. So anyway, Peter, just one quick question before I let you go. We've titled our show today, Who's Right About Gold, Goldman Sachs or Eric Sprott? What Eric Sprott is talking about $5,000 gold. I think Goldman is looking for $1,000 gold. What are your thoughts? Who's closer to being right? I don't know about 5,000, but I think it's going to head in the direction of Sprott versus Goldman Sachs. We've seen everything and the kitchen sink thrown at gold these last few years. We've seen everybody turn about it. We've seen the whole financial journalism side, almost everyone write negatively about it. And yet we've seen tremendous physical demand on any weakness. The thing that has upset gold bugs, if that's what they still want to call us or what have you, is that the mining share industry got decimated. So there's been a sense of a feeling that gold has done a lot worse than it really has. If you're just speaking about physical gold and not looking at mining shares and exploration stocks, what we went through was just a classic correction after 12 straight years of going up. Sure.
That correction is over, and I suspect that we're going to see gold continue to work its way higher. And when it gets above 1,400, the all-clear signal will be given, and don't be surprised that you hear suddenly that Goldman Sachs is bullish again.
Yeah, well, probably after the fact they will be, and then they'll try to claim that they were always bullish. Well, anyway, thank you very much, Peter, for your insights today. It's always good to hear from you.